Hi students, good evening. I hope all of you will be fine. Today what we are discussing is the concept of the depreciation. Okay. That is very important concept in the accounting because there are so many misconceptions regarding this concept. So we will discuss the basic concept of the depreciation, why depreciation is needed, what is the purpose of the depreciation, then the different types of the depreciation, and then what is the effect of the depreciation on the financial reports or in the financial information. So first of all, we have to understand the meaning of the depreciation, that what is the meaning or what is the basic purpose of the depreciation. Now, it is a general word that normally used, the concept of the depreciation, but in the accounting the concept is a little bit different. So how it is different? Normally what we consider that there is a reduction in value due to use, that there is any reduction in the value of the asset due to the use of the asset, but unfortunately that concept is wrong. Some people call it as a wear and tear of asset. That again the concept is same, that when you are using the asset, then again what is the possibility that there's some wear tear is there, some value reduction is there. Again this concept is wrong. So in some of the books also it is written that it's a wear and tear, or it may be a reduction or the gradual decrease in the value of the asset. So these concepts are wrong. So the basic concept, first of all we should understand that what is the concept of the depreciation. Okay, now let's say the company needs a building. Okay. Now the building is a fixed asset, what we say the non-current asset or the fixed asset. What is non-current asset or what is the fixed asset? That any asset that is used by the business has some economic value and that life of that asset is more than 1 year. So that is the non-current asset. So one building is the, one example is the building. So the depreciation is for the non-current asset. First of all, we should understand that it is for the non-current asset. So depreciation is only for the non-current asset. Now, if a business needs a building, so they have two options. Okay. First option is that they can make an agreement for the rent, so they can get the building on the rent. Other option is that they can buy the building. Now both options are okay for the business, but it depends that what type of the business investment they want to know. If they know that there may be some change in the business plan or they want to change the location after some time, so they may take it as on the rent. Now the other option is that they go for the buying of the asset, and if we buy the asset, it will be written in the non-current assets of the financial position or in the financial statement. Now if they rent it, it is simply an expense. So we are not considering that one, that they are getting a building on the rent. We are considering that they are buying an asset, and asset is the non-current asset. The life is more than 1 year. So that is very basic concept. The life of the asset is the more than 1 year. So maybe a building, it also depends. Furniture is there, it may be a vehicle, or it may be any machine or any equipment. So all the non-current assets, the depreciation will be applied. So now very basic and very useful definition of the depreciation. So depreciation is allocation, or we can also say as a distribution of cost of asset over its useful life. A little bit looking like a technical thing, but it's very basic, very simple thing, and if we go through this video or in the lecture, we will understand the very basic concept of the depreciation. So if you see here now of what, first of all, it is related to the asset, and if we're talking about the asset, it means we are talking about the non-current asset. So the non-current asset, what we call it as a NCA. So first of all, it is related to asset. Then the second thing that is very important is what is the distribution. Okay, now distribution, or what we say the allocation. Okay, now allocation of what? The cost of the asset. And the next important thing is what? That is the life of the asset. So it means we have a first thing that is important, that is the concept of the asset, and that asset should be a non-current asset. The second thing that is important is the concept of the cost. Okay, the third thing that is important is the life of the asset. So, and the fourth thing that is important, it is what? It is the distribution, or what we can say as a allocation. So these 4 points are very important when we are discussing the concept of the depreciation. So non-current asset, and then one more thing that is very important, the depreciation is always for the non-current assets and those assets which are tangible. Now, a tangible asset, what is the meaning of the tangible assets? Any asset which has a physical existence. As we said, it may be a building, it may be a vehicle, it may be some furniture, it may be some machine, some equipment, or any tool, or any other thing which has an existence, the physical existence. So we will apply the depreciation. And the one again more important thing, that if the life is above 1 year, if the life is like 6 months, 4 months, 10 months, so it will not be considered for the depreciation. But if the life is like a 2 year, 10 year, 50 years, so then we will consider the depreciation. Now, 4 things that are very important. It is applying only to the non-current asset. The second thing, it is applying to the cost of the asset. The third thing we should consider the life. The life means the useful life of the asset. And the fourth thing that is important, that is depreciation is simply a distribution of the cost of the asset over its useful life. So now we will consider all these concepts. We decided here that to have 2 options, either they can buy a building or they can take a building on the rent. For example, now if they are taking it on the rent, let's say we assume like they are paying $5,000 per month. So every month they have to pay $5,000 if they are taking the building on the rent. Now $5,000 this month, next month, so up till the agreement is there, so they have to pay some expected amount for that rent. So this is the expense, and the expense we will write where? In the income statement. So this is the business expense. Other option is that instead of this 5,000, they just buy the building for, let's assume, $200,000. They just buy the building, and then if they buy the building, it means the cost of the asset is what? That is 200,000. So the first thing we decided is what? That is the asset. And which asset we have purchased? That is the building. So first concept is clear, that it is the asset, it is a non-current asset, and we are purchasing it. So the first condition is okay. The next thing, the cost. The cost of the asset, we said that it is $200,000. So they are buying a building, they are purchasing a building, they are making the agreement to purchase the building for $200,000. Now the next thing that is very important, what is that? That is the life of the asset. Okay, the building has normally a life of 20 year, 25 year. So it is not for like a 2 months, 3 months. So every month you are not purchasing a new building because it is finished or it is vanished or it is destructed. So it is normally for 10, 20, 50 years. We just assume it like For example, the life of this asset, the life of this building is what? That is assumed that it is for 20 years. Now, it means the business is paying this 200,000, the cost of 200,000, but the benefit they are getting for next 20 years. So it means this is the expense of the business, but expense for not 1 year. This expense is for how many years? This is the expense for next 20 years. For next 20 years, they are using this building for the business purposes. So it means, in a simple way, we can say that they are paying what? They are paying the amount of the building as an expense for next 20 years. For next 20 years, they are just clear with it that they will not pay any other amount for that. So they are paying $20,000 or $200,000 or whatsoever is the value of the building. And this expense or this cost is for what? This is for the next 20 years. Now, we have to distribute it. What we have to do? We have to distribute this cost. How much was the cost? That we said that is $200,000. So this cost should be distributed over what? Over the useful life. Now means what? The cost 200,000 we paid for what? For next 20 years. So how much is the cost for 1 year? So that is simply a distribution. So if we divide simply this 200,000 with the 20, so the answer is almost how much? Like a $10,000 per year. So this is what? This is the depreciation. So depreciation is basically what? It is a distribution of the cost of the assets over its useful life. So in the simple way, we can say that this amount they have paid for how many years? For next 20 years. So how much is the amount? It means how much is the expense for the 1 year? That is almost 10,000 per year. So it means that is the depreciation of the asset. So it is the cost and then it is distributed over its expected useful life. So we assume that this asset or this building will be used for the next 20 years. So it means we can say that for next 20 years the building will be used. So 10,000 is what? That is the depreciation of the asset. And this appreciation is what? This is the expense for the business. So this is the total, obviously is the expense. But expense for how many years? For 20 years. But now we distributed, we just allocated that for 1 year how much is the expense? This is almost 10,000. So this is why this is 10,000 is the depreciation expense. Is what? Is the depreciation expense for what? For the building. Now hope that you have understand the basic concept. So the basic concept is what? It is the asset. The asset should be non-current asset, and the second condition, it should be a tangible asset. And then we have the four things. The asset should be non-current asset, then we have to consider its cost, we have to consider its life, and then we have to distribute the cost of the asset over its useful life. So it is simply a depreciation for the asset. So there are 4 or 5 main things that you have to consider while recording or while calculating the depreciation. So depreciation is simply the allocation or the distribution of the cost of the assets over its useful life. Now the asset is, let's say, assume 5-year life is there, so we will distribute this 200,000 on the 5 years. It may be 4 years, so we'll distribute the amount on the 4 years. So accordingly, the depreciation will be different for the different type or the classes of the asset. So this is the basic concept of the asset.